Welcome to this video on the ratio hedge spread. Make money whether the market goes up or down. In this video, we'll talk about hedging your portfolio and some ways that can be done. What is hedging? The bought put, the bought put spread, and the ratio put spread. And that's what this video is really about. So what is hedging? A market hedge is having a position that will profit when the market goes down. The majority of your portfolio makes money when the market goes up. You own stocks, you own funds, you own calls, things like that. If all of your positions are like this, then the value of your portfolio goes down when the market goes down. And ideally, you want to limit this effect. A standard way to do this is to diversify your portfolio, hoping that not all sectors will go down at once. Another way is to buy some kind of insurance. This can compensate you when your main portfolio loses value. This insurance usually comes at a cost, which can lower your return when it is not needed. So let's look at some ways this can be done. Buying a put. It's a simple way to hedge. A put will increase in value as the price of the underlying decreases. It really gains in value when the underlying price goes and stays below the strike price. And I've made a video on some of these standard puts, so I encourage you to go check those out. Buying a put costs money in the form of the premium you pay up front. If the put expires worthless, then the premium paid is a loss and goes against your total portfolio. So here, if we have no position, then we have zero. We have nothing happens if market goes up, nothing happens if it goes down. If we buy a put, say a $30 strike, then above 30, it will expire and will have paid, so we'll have lost that premium. And below that, it will start to go up, we'll start to make money until we recuperate our premium, and then we'll be in profit. Next, buying a put spread. You can reduce the cost of the insurance by converting your put into a put spread. So that means that you've bought the put, but you also sell a put with a lower strike price to get back some of the premium. This reduces your risk, but it also caps the gain that you can make from the insurance. We're going to sell a $20 put, and then we're going to limit our loss, but we'll have moved up our premium paid, so we'll have paid less, and so our profit will be less, our loss will be less in the case where everything expires worthless. The ratio put spread, here we are. The ratio put spread gets its name from the fact that the number of puts in the spread is not the same for both strikes. A typical example is you buy one put at a $100 strike and sell two puts at the $80 strike, which is lower. The goal is that the premium received from the two short puts will completely offset the premium paid for the one long put. This means that even when the underlying price does not decrease, you can still make a bit of money because you were paid to open the position. If you have a diversified portfolio, it's a good idea to use some kind of market fund for this strategy, like an S&P 500 or something like that. We sell another $20 strike put, so now we have one $30 put that we bought and two $20 puts that we sold, and now we have our graph where we're in a profit above 30 because we received money to open the position, and we start making more if the price is below $30. We make the most, our peak, at $20, and it starts to go down as we go below $20 until we get to a bit under $10, because this is taking into account the premium that we received, and then we'll start losing money. But what is it really? Well, the ratio put spread can make money even when the price does not fall. If the price falls too far, the strategy also loses money. Well, how far? That's determined by the chosen strikes. The higher of the two strikes is the price at which the position starts to make money. That's when your put is in the money, and then it's worth something. You can sell it to get money back. The lower of the two strikes is the price at which the position makes the most money. We've seen in a spread, once you get past, if you go all the way past the lower of the two strikes, then your income is constant. It's the difference between those two strikes. But below the lower strike, unlike a simple spread, this position starts to make less money until it reaches a strike that is the lower strike minus the difference between the two strikes. So that sounds complicated. What does that mean? Once you've started to make money, then you'll make money until you reached the lower strike. At that point, it goes, you make less money dollar for dollar as the price decreases until eventually that reaches zero. If you had an example, the higher strike was 30, your second strike was 20, you start making money at 30 and you make the most at 20, and then between 20 and 10, your profit decreases, and then at 10, your profit is none, and below 10, then your spread is actually costing you money. And that's when the position really loses money. So how do you choose the strikes? You can choose the strike based on the current price and at what price you think you need protection. Maybe you consider a 10% drop from the current price as normal and not in need of protection because the market goes up and down every day. But after that, you would like some. So you could choose the bought strike at about 90% of the current price. So if it dropped more than 10%, it would compensate you for that. Then you want to choose a strike below that that has a premium of at least half the premium you'll pay for that first put. This way the position won't cost anything to open. Why is it half? Because you're going to sell two of them. So this is example data which I took from the market on Friday for the VOO fund. And these are the option prices, and I've limited it to about a 3-month expiration, so 105 days to expiration, which is January 17th, 2026. And these are all the strikes that are available that I picked in my range, so below the current price. About a 10% below. And these are the premiums for those options, average premiums. So if we were going to sell the 560, this is the cost of a spread, say a 450, 560, 455, and so forth. So this tells us when we can actually be paid to open this spread. So if we did a 560, 555, that would pay quite well, but that's fairly risky and that the spread is very narrow. So this can, you pick within your comfort zone. And here we'll see that the 515 strike is the biggest spread we can get where we can still get paid something. It'll be $30. Here would be $100, $140, $200. So you can pick, you want to balance between, if you really think the market's going to, there's a risk or not, and your tolerance for that risk, that you can pick these. But you would stop here because here, this would be reducing your, no, there'd be no reason to do those. You want to pick something where you get paid for it. That's the whole point of that profit. If you wanted to accept, sell the 555, then these are the numbers that you would get. You could go all the way down to a 510 spread to open that position. So this is how you can look and decide, well, how big a spread can I get? What starting strike am I interested in? And then that will tell you whether, you may say, these numbers just don't work for me. Just don't open the position. Wait for a better opportunity. You also want to be comfortable with the spread as it defines the max gain and when the hedge can cost you money. The lower strike minus the difference between the two strikes is that limit. So another example, if the first strike is 300 and the second strike is 280, then 280 minus 20 is 260. That's when that will happen. And 280 is when the position makes the most money. So you have to understand this is a position which can lose money. So You have to do your calculations and be comfortable with that. For this strategy, how do you choose the expiration? I think the expiration should be fairly short. As we'll see, the full value can only be realized at expiration. It's because of the ratio and the time value of your position. And also, you'll want to adjust the strikes as the market moves. You'll probably want to open multiple spreads during the year. I would suggest at most a 3-month expiration, but that's really up to you. And shorter than that is fine too. And this allows you to run the strategy more times. So you really have to try these out. I would probably encourage you to just do examples, paper money, don't risk anything. And I'm not encouraging you to do anything specific. I'm just giving you examples of how this strategy works. Okay, so here we're at the trade options screen, and I'll pick the symbol, fill that in. I'm going to pick the strategy, and here a whole bunch of them, but they do have the one we want, which is a ratio put. I can choose that. That will allow me to enter a different number on my spread for the sale and the open. So we decided we were going to do a January 16th expiration date on both. So we'll put that in here. So we'll buy, and let's just say we wanted to buy the $560 put. That's when we want our protection to start. And the biggest spread we can get to still have a credit is the $515 spread, which would be that. And that confirms what we had in our spreadsheet. We see a credit of 35 cents. Confirmed here, net credit means we get paid that amount. For one, it would be $35 as we see here. And if we wanted to do that, we could just say review order. And if we ever liked it, then we could place that order. And that's a simple way to do it. So this is what that would look like on a graph at expiration. I'm going to show this as a spread. So a 560, 515 spread would be that graph. And then adding in the extra sold put. So that would make money below 515 as well. And then if we combine those together, that is what the graph of the ratio put spread looks like. So we have a profit above 560, which was our chosen higher strike. It goes up below that to our peak at the second strike of 515, and then it goes down, same slope, below 515, down to just below 570-ish. 470, sorry. And below that, we're at a loss. So that's what the strategy looks like. Let's look at some real-life examples. This first example was on the SPY, it's the S&P 500, and used the 405 and 380 strikes. This was a while ago, on April 11, 2022. The position was opened by buying two SPY July 15, 2022 expirations at the $405 strike for $9.60. At the same time, selling four SPY, same expiration, $380 puts at $5.64. This netted an income of $332.02 to open, so that was nice. At the time of the opening, the SPY was around $439, so the 405 strike was almost 8% below that. The max profit of 380 was 13% below the current price, and the loss point, 380 minus 25, 355, was just under 20% below the current price. So that's what I was willing to accept at the time. So we expect nothing for drops below 8%, but we'll profit if the drop is between 8 and 20%. With the max profit being around a 13% drop. And you can see that the ratio is still here at 2 to 1, even though it's basically a double. Instead of 2 to 1, it's 4 to 2. It's the same ratio. So this is what happened to the price. Started out around 440, and it generally went down over time. And this is what happened to the value of the position, so what it would cost to close or bring in. So we can see that even though around day 50 or so we're kind of at the max profit, we don't realize that max profit until we really get to the end. And that's because of the remaining time value and the fact that it's a ratio put. So it's not worth anything in the beginning, and then in this lucky case, it was worth something, and then it was worth almost the maximum that we could want from it. So on July, the price mostly dropped during the period, going as low as 365. In the end, it was quite close to the perfect value in the high 370s. This meant that the owned puts could be sold at a good profit, and the short puts had to be bought back for a small amount. So we sold the 2 long puts for $20.98 each and bought back the 381s for 9 cents. And this netted an additional $4,155 to close the position, in addition to the premium that we got for opening the position. So this is an example of when it works out very well. This doesn't happen very often. I think this is the only one that's worked out that perfectly. Another one. The second example, also on SPY, used the 380 and the 365 strikes. This was in March of 2023. Bought some June 16 380 puts for $785 and sold 4 June 16 $365 puts at $505. So that netted an income of $446 to open. And this time, at the time of opening, SPY was around $390. So the 380 strike was actually quite close to that. The max profit point of 365 was 6% below the current price, and the loss point of 365 minus 15, which is 350, was only 10% below the current price. So this one was a lot tighter than the previous one. So expect nothing for drops below 2%, but will profit if the drop is between 2% and 10%, the max profit being around a 6% drop. You can see again that the ratio is still a 2 to 1. And for our second example, this is what happened to the SPY price. In this case, see it started just above 390, and it slowly increased and basically never entered the territory where we'd be making any money for our position. So we'll just keep the money that we got when we opened it, and that's all we'll get. And we can see that here from the graph of the value of that position. So starts out, we'd have to give back the money basically to close it, and we give back less and less as it becomes less and less valuable until eventually it's worth nothing and the options just expire, as so many options do. In that case, it's still a good result. We didn't make any extra money, but we kept the premium that we got when we opened the position, which is the advantage of this strategy. So on June 16th, all the options expired worthless, as the SPY, instead of 380, was up to about 439. Well, thanks for watching. As always, please like or subscribe, and let me know if you enjoyed this video and if there are any other topics you'd like me to cover. So I'll see you next time.